Hello, fellow traders. 'Tis I, the Rumpled One, coming to you on Tuesday, August the 16th. The year's 2022. Let's talk trading. Passing the prop firm test. These videos are for educational purposes only. Your results may differ from mine. There was a trader out there. I can't remember if they asked me on YouTube or Facebook or an email, but they wanted me, they said a good idea would be to put together a video series to show traders how to pass a prop firm test. Now, the thing about prop firm tests are they have some strict parameters. And one of the parameters is the maximum loss per day, and the other one is the maximum loss during the trial period. So say, for example, there's a few good prop firms out there, and usually you can start with a $50,000 or $100,000 account. And what they'll allow you to do is lose a maximum of 5% per day and a maximum of 10% for the evaluation period. And in order to pass the evaluation period, you usually have to trade a minimum of somewhere between 5 and 10 days out of the evaluation period, and you have to return a 10% profit. So if you get out your piece of paper and you start doing some math, usually there's 20 to 22 trading days in a month, in a calendar month. So let's just use 20 for a round number. So if you need to make, say, $5,000, then how much do you need to make per day? Pretty simple calculation, right? If you take 5,000 and you divide it by 20, that's $250 a day. Now, in order to make that 250 and not lose, say, the 2,500, you now have to look at how heavy do you want to trade. Do you want to trade one lot at $10 a pip? Then you have to make 25 pips. So the question is, can you make 25 pips a day? Have you made 25 pips a day? See, this is where it gets interesting. You'd have to go back and look to see on your winning days, how many pips do you make? And so the question comes down to whether or not you can consistently make those pips. So let's just say you can consistently make 5 pips a day. If you can do that, then if you were trading $50 a pip, you make your 250. But to the downside, if you start looking at how much you lose on your losing days, that's going to tell you another story. So you have to figure out, what's your worst loss in pips? Is it 20? Is it 50? That's what you have to look at. So in order to, crap out on one of these prop trades, if you were to lose $250 each day, you would crap out. So the point I'm trying to make is it's a balancing act. And it really gets down to managing the money, which is what the prop firms want you to demonstrate, that you can manage their money. So for example here, I brought up the Walmart chart, the H1. We were at the bottom of the hour. And if you would have taken the trade at 60, there was a chance to make about 7, almost 8 pips. So if you were trading $10 a pip, you would have put away, let's just say you made your 5 pips. That would have been 50. So that you would have been 1/5 of the way towards your daily goal. On the other hand, if you were trading $20 a pip or 2 lots, you'd have $100. You'd be 40% along the way. And so looking at the Walmart lines, if you were to take a trade at 60, if you set your stop loss 10 pips away, and you were to lose, and you were trading, what did we say, $20 a pip, you'd lose $200. That'd be 80% of a daily loss if you wanted to say 250. Now here's where it gets even more interesting. Let's say you had a winning day, and let's say you made 250. So on the next day, you could lose 250 and you'd be back to even. So, and if you lost 500, then you would have had your loss for the day. So in other words, you can start risking the profit along with that wall of 250. I hope you're tracking with me. In other words, let's just say, for the sake of argument, you're on your last trading day and you're up 4,000. You could actually go down to like 8,999 minus, and yeah, you would lose the challenge because you didn't come in properly, but you wouldn't blow the maximum loss for the trial or the test. And that's pretty much what I'm talking about. So the whole idea is you can kind of make a little chart, and you can say, on this day, this is where I need to be working towards passing, and this is where I need to be to make sure I'm not falling too far behind. And that's just one way of looking at it. And then again, say using a Walmart method and just taking those small bites, as you can see here, there was an opportunity to go long again. And look at the 1 minute chart. So this line isn't a trend line. It's basically saying price opened here and is now here. So you see here, the Walmart line, there was an opportunity maybe to go long here, but actually you take the breakout of the H1, the previous H1. So there was a breakout there for a couple of pips, another one for a few pips, Another one for a few pips. And there was one here for a few pips. If you took the short, let's see, where did that wind up? Open 51, low 47. So there was one for a couple of pips. And again here, a couple of more pips. Here, a couple of more pips. So you can see here, if all you did was take 2 pips, I think I said that about 5 times. This hour, let me look again. 1, 2, 3, 4, 5. So there's opportunity to take 10 pips out of that. And if you look at the hourly range, right now it's 21. And you can see here from 60 to 68 is only 8 pips. But if you would have hit this line 5 times and taken 2 pips, you'd have 10 pips. Question is, which one would you rather have? Would you rather have 8 or 10? I know that sounds kind of silly, but if you think about it, if you go back to the 1-minute chart, you see how prices oscillated across this line. You don't know when you're going to get that big move. And it's not usually, sometimes you'll get a big candle, but most of the time you're going to get this oscillation. So if you can see that oscillation, then you can see how 2 pips, you can 2 pip your way to passing the test. And if you notice, somebody, the whole idea behind this was they were asking me, how can you trade a horizontal line and what's the money management so you can pass the test? So are you going to win every time? Of course not. But you're just going to make sure that you don't give up more than 250. So maybe if you're going to win 2 pips, maybe you don't want to lose more than 3 or 4 pips on a trade. And you set your position size accordingly. You can't trade too small because then it's going to be really hard to make it and pass the test. You can't trade too big because, a flash move could take you right out. So as you're making money, you're going to want to possibly up your position size. So you can take advantage of that leverage. So we'll discuss this. Walmal's on vacation this week. I don't know if I'll be able to get him on, but maybe what I'll do is maybe I'll make a spreadsheet or something, or a graph to show you, give you a tool to use. But there's no one set way to do it. For each trader, they're going to have to figure out their own money management, because you might not be comfortable trading $50 a pip or $100 a pip. You might only be comfortable trading $10 a pip. But you just have to keep in mind, at $10 a pip, you have to average 25 pips a day to make that 250, to make that 5,000. And as you can see right now, I'm out of time. So it's not what you trade, it's how you trade it. So go out there and drain the bank.